Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Friday. Friday, hold on, I've got the wrong screen up. Friday, May 9th. It's currently 10:41 a.m. on Friday to put a timestamp on it with what the market's doing right now. And it is Investment Friday. I'm here with Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. And we just spent like 40 minutes talking about all kinds of stuff and we're recording it. So, not that we meant to record it, but I just thought I would give you a little insight into kind of how much we do talk about things, how much we care about what's going on in the economy, and how much we're talking about our clients and um, what they're experiencing and what we need to do as the investment professionals in the room. So, Brad, thank you for being here as always. What's going on for you this week?
You're welcome. A lot. It's an interesting time. Every time Donald Trump is serving as president, it's a mix of day-to-day, hour-to-hour chaos. So it keeps life interesting for all investors and market participants, like myself, like you, and our clients. So unfortunately, it creates a situation of uncertainty that a lot of clients fear and those types of things. Um, but again, I don't think clients should be too fearful. As we've seen, the markets have rallied, and this could be one of two things. It could be either a bear market rally, or it could be just a resumption of the bull market as investors are looking through the tariffs, and essentially they're just saying, we don't think the tariffs are going to be that big of a deal. Um, at the end of the day, we don't think it's going to be that big a deal, and we don't think it's going to harm corporate earnings that much. Right now, as we sit here, we're down 7.5% off our high. The S&P 500 is down 3 to 4% year to date. So again, very mild numbers, not a big deal. Um, my 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 analysis suggests that it will be a bigger deal to corporate earnings than is currently priced into the market. So do we think we're going to have volatility coming up? Yeah, we're probably going to have some more volatility coming up, particularly if we don't get trade deals that do kind of uh, harm trade a little bit more quickly than, let's say, tax breaks can kick in and incent spending. So it's some of those things that we have to think about and the timing of those implementations. Um, the United States came out and announced yesterday. I'm not sure if anybody saw that on the news, but President Trump announced a trade deal with the United Kingdom, um, and said it was it was sold as a full agreement, that kind of thing. And really what it comes down to is it's a framework that they're going to now start to write up a trade agreement with the UK. A lot of the tariffs, some of the tariffs are still in place. Other sectoral tariffs, which means sectoral tariffs are tariffs that are applied to one area, like steel or automobiles or the like.
Mhm.
Um, we have some sectoral tariffs still on, but we have others that were taken off completely. And so it's interesting. They did open the market to ethanol, the UK market to ethanol, which was previously not in place. Um, so, again, the United States had a trade surplus with the UK last year. So just to give everybody an idea that because the UK wasn't under a massive pressure from President Trump, this was kind of an easy deal to do.
Mhm.
This was not Japan or the European Union or China that have a very large trade deficit with us. Um, so it's something that we just have to temper our expectations. We could see some volatility coming up here you know, through May, June. But beyond that, I think they're going to have uh, a lot of deals coming to bear.
Well, one of the other pieces of news that came out last night was that Trump is planning to lower the tariff on China from 145%, which is where it's been for the last couple of weeks, down to 80%. Um, but he's letting Scott Bessent, who's the Treasury Secretary, decide the final details of that. It's just, what the headline that I saw talking about that. But economists pushing back on that a little bit are saying, okay, 80% is better than 145% for small business owners and consumers and big business, like just in general. But what we can actually digest and like raise prices, digest some of the tariff, everything that we've talked about so far about how companies are going to manage this, raise, some different duties on consumers. The max is probably about 50% of what businesses and consumers can actually, we'll call it metabolize in the economy. So we're still above that threshold to where there will be pain, there will be shortage, there will be small businesses that go under um, because they can't handle that tariff load. So what's super interesting, and we talked about this just, you mentioned it a little bit, that the market, the way the market is trading right now, so it's gone up consistently for the last couple of weeks now, um, is actually like acting like, oh, the tariffs are going to go away. They're not going to be an issue. Corporate earnings are going to be fine. That's what we expect. And my question there is, even if the Chinese tariffs are at 80%, like is the market pricing in that it's just pretty much going to go away and that's not even going to be a factor anymore?
No, the market is pricing in is not even 80%. What it's pricing in is uh, Trump relenting significantly on the China trade tariffs. So, he raised it to 145%. So that's virtually a trade embargo on Chinese trade, which is what we've heard a lot in the news over the past couple of weeks or month per se. But what the market is thinking is, okay, he's already come out the day before, 2 days before the talks start with China. So far, the US and China have not had any trade talks at all. They've just set the meeting. That is why Scott Bessent is flying out tomorrow to Switzerland to meet with the Chinese trade officials to start the talks. Now, President Trump has already said, 80%. Okay, so that's already him relenting significantly from, I mean, not by half, but pretty close
Yeah.
of bringing it down. And that's where they're going to start talking. My guess is they're going to get to the 40 to 60% range, and then open. And this is really the primary target, I think, of the Trump administration is to open the Chinese consumer markets to U.S. goods, not just to, because right now the United States cannot export some goods into China because they are protecting that industry for whatever reason. Um, so I think that the idea is to open the Chinese consumer market, which is very, very large. We just talked about that in the last couple of weeks. I mean, it's $6.5 trillion in US dollars terms. Even though per capita it's much, much lower than the US, it's bigger than the US in totality. Okay, so it's really important to understand how important China is to the global economy. And that's the Trump administration is using these negotiations to open the markets for more U.S. goods, and get and really having the Chinese government crack down on illegal pirating of intellectual property and the like. Um, we'll see how far we can get into that process and what kind of details, but if it the market right now is assuming that the Trump administration can still charge 40 to 60% tariffs on Chinese goods, and that eventually over time we will de-emphasize them in the supply chain in certain areas. Okay,
Mhm.
so people are having this big deal that we're going to onshore a lot of manufacturing. Yeah, in certain things we will, but not in a lot of things. A lot of things it just won't be. They may not stay in China. They may go to other countries, but they won't be coming back to the US until the point we can get completely automated um, manufacturing processes where we don't have a lot of high cost labor. A company makes a very large upfront investment in the robotics, has a few employees manage the process, and it's kind of on its own. It can run 24 hours a day, 7 days a week. And that would make it very cost effective um, in the United States. But until we get to that point, having I think it's a little unreasonable to think that a lot of manufacturing is going to go from China to the US when there's very, very many countries that would open their doors for that type of manufacturing in Latin America, Africa, Central America, other parts of Asia, and the like. So, to me, it's like we'll see. But to your point, the market is trading as if the tariffs are a non-event.
Mhm. Yeah, and it's we've talked about this before, but it's always good to emphasize and just remind people that again, the stock market is a forward-looking indicator. It's it's pricing in what investors think is going to happen over the next 6 to 9 months. It's not, you know, it- as President Trump said on Truth Social a little bit, maybe last week or so, it's not the Biden economy. It's not a backwards looking indicator. There's nothing today in May from, you know, 5 months ago, 7 months ago, 8 months ago. That's not how the stock market prices things and how it works. We can't just decide here and there, like, nope, now it's looking backwards, now it's looking forwards. It's always looking forwards. It only cares about the next quarter, the next 2 quarters. Um, and anyone who works in corporate America is very, very aware of that, right? Like there are companies right now that are downsizing, that are making some shifts in their workforce due to economic uncertainty. And we can talk about that sometime too, right? Like, what does that really mean? They're just seeing an opportunity to maybe do some of their own offshoring that they weren't doing before, but have wanted to do. And this is an opportunity for that. Like, we have some uncertainty going around, so we're going to go ahead and do that offshoring of our different teams. Um, but again, it's always looking forward. It's always looking to how do we make sure the next quarter is profitable. It's not looking at what happened last quarter.
Yeah, in
Uh,
fact, that used to be a joke when I worked at a very large bank managing money. I was, you know, 12/31 of the year, December 31st, everybody was so elated if you did well or depressed if it didn't go well. And then January 1st, when you stepped into, your first day of the new year, they were looking 12 months ahead. They could care less what you did yesterday. So
right?
yeah,
Exactly.
it's
Exactly.
it's a very interesting. You don't celebrate your successes for that long before you are right back at zero and you're having to kind of dig out of that hole a little bit. So it's something that you're going to have a lot of those, corporations who were looking to make changes in their business model anyways, whether it's rationalizing costs by, like you said, hiring other companies, maybe outsourcing companies or services to a certain extent, um, or changing in some other way. They can use the kind of excuse or the narrative of economic uncertainty because it's real. right? We have uncertain economic times, um, and that can give them the impetus to go ahead and lay off some and make those changes, which unfortunately oftentimes includes laying off employees.
Right. Yeah, and that's to your other point about manufacturing. This like I just remembered this. And I had this conversation with my older brother, gosh, it was in like 2009, I think, because I remember talking on the phone while being pregnant. No, so it would have been like 2010. I was walking up a hill in Price Hill. If anyone is in the Cincinnati area, it's very hilly there. Not quite San Francisco, but there's some steep hills. So I'm like talking on the phone with my brother because he was trying to convince me to um, be not necessarily invest in, but like be a part of. He wanted to buy a garment manufacturing machine that did it
Oh,
completely automated, and they were expensive. Right. And he's like, but I think we can do this and that. And he's telling me all about it. And I was like, I don't think I can do that right now. Um, but so, I mean, even back then, so that was 15 years ago, these things exist, right? Different ways to automate some of these systems, garment production. I think there are even some companies in America right now that are doing the same, like automated with like sheets and bedding, because that's pretty easy. There's not a lot of, literal garment construction that goes into that. But if garment manufacturing or fabric manufacturing comes back to the United States, it's going to be like that, right? It's not going to be, a factory full of seamstresses.
no, no, no. And we don't want that because those are low income jobs. And the United States has a very skill-based economy, whether it's manufacturing, whether you apply that in the manufacturing world or you apply that in the service sector, we are a very high skill, for the most part, a high skill, high income economy. And that's the way
Mhm.
we should stay. Um, but for example, I think Amazon's a great example of this. 20 years ago in their warehouses, it was all people
Mhm.
and they were scurrying around, they were picking loads, they were wrapping it, and it was very and very, very heavily labor intensive. Um, and over the past 20 years, they've developed technologies or they've bought technologies that have allowed them to automate a lot of those jobs.
Mhm.
In fact, they have some really, really cool automated robots. I mean, they don't look like robots to you and me, but they are effectively.
Right.
Um, and they go and they do certain things, and it's amazing what they do. And so Amazon is doing it. Um, we're not quite to the point where small business can afford to do that. I mean, Amazon obviously is a company, one of the largest companies in the world and prints cash like they have a printer. So they have the wherewithal to do it. But again, that will eventually start to come down in cost, and smaller and smaller businesses will be able to take advantage of that.
Yeah, and I think that's important to just keep in mind in this whole conversation, that even if we bring certain types of manufacturing back, which we're working on in different ways into the US, um, we are still largely a knowledge-based economy. And one of the examples that I gave for that for a couple weeks ago was that when I am responding to a client, like we are in a knowledge based industry for sure. When I'm emailing a client, I am literally taking my experience and my knowledge and saying, okay, here's the situation that you're in. Here's what we can do. Here are options. I'm spending my time on that. I am doing work, literally, like when I do email as my job. Sometimes that email, it can only be written and formed because I have a lot of experience and knowledge that I can share and that people are paying me for. And that is like I wouldn't trade that for a factory job ever. And
No,
I don't think most people would if they're able to work in a way that they can use their experience and their knowledge and they don't have to do a labor intensive, dangerous, like those picker jobs were dangerous in a lot of ways.
oh, not a
Um,
lot of ways, almost always.
yeah, it's
I mean,
not
whether you're breathing in poor air from the exhaust in the machines to the machines cutting your limbs off. I mean, back in the Industrial Revolution, that was a very, that's why OSHA came about. It was
right.
crazy.
Right. And a lot of, a lot of our parents and grandparents, have literally explicitly said, like, I worked this job and I sent you to school so that you would not have to do this job.
Right.
And so to like just to keep that in the conversation that we want an educated population that can do these skills based and knowledge based jobs. Um, and that's, that's my for my own children. I have three kids. I hope that they have, the ability, the opportunity to do things that they're good at, that they're skilled at, that use their creativity, their curiosity. They get to use those skills versus, you know, go bust concrete for 12 hours, which
Yeah, no.
it's not
It,
fun.
yeah, and just to make sure that everybody understands that the manufacturing world of today and really in the future are going to be knowledge skill based jobs. Like you're going to have to know how to work on robotics. You're going to have to know how to solve problems. You're going to have to be able to manage those processes, and that is going to be very skill based, very knowledge based. It's just when the Trump administration talks about bringing manufacturing jobs back, they're not going to be the jobs that of yesteryear where you were actually doing all these things like the seamstresses you mentioned earlier. That's not what we're bringing back. We're bringing back a manufacturing where you have basically all robots and machines doing 90% of it, and then you have human element 10% of it. And
Mhm.
that human element is going to manage the entire process from, maintenance of the machines and the robots to selling the goods, you know, uh, safety design, designing the goods, that type of stuff will happen, at the US. So that's the kind of thing that I think one, I welcome. I think it's an important part of bringing of a balanced economy. But two, um, there are some strategically important industries, manufacturing industries, that really should never have left, but they did leave, and so now we need to bring them back. And I think the pandemic really highlighted the fragility in the supply chain, and also the ship, the Ever Given, when it got sideways in the red in the Sinai Canal. It seems, what
I don't
canal
know.
is that?
Suez?
Thank you. Suez
Okay.
Canal. The one that went from the Red Sea to the Mediterranean. That's the one I'm talking about. You know, I don't think people understood how narrow the Suez Canal is. And that one ship, bear in mind, it's a massive ship, you know, got a little sideways and it blocked the supply or that traffic through that canal, which was one of the major trade canals, like trade routes. It's on the major trade route, so that snarled the supply chain as well. So we had some really quick examples of an efficient but yet fragile supply chain,
Hmm.
and that maybe countries need to, at least large countries like the United States, needs to be a little more circumspect as to what industries we have in the United States. You know, it's my opinion. No one listens to me in the Trump administration, so please just know that, um, is that we have systemically important ma- industries. Okay. Um, Certain types of medicine is one. Certain type of defense products is another. and some technology which is related to our national security. Those, in my mind, are at least three of the sectors that we need to be protecting and keep here. Agriculture obviously is one of them, but I don't see that as a real threatened one because our ag economy is so large. But again, we want to make sure that we're protecting those industries so that we have the basic necessities of life, which, unfortunately for medicine, the average person in the United States over the age of 50 is on quite a few medications. It shouldn't be that way, but it is. So, um, you know, we need to have a stable supply source regardless of what goes on around the world, whether it's a war or whether it's a ship getting sideways in the Suez Canal. We just need to have that stable source so that the citizens of the United States can rely that they will be safe and healthy and be able to pursue their lives.
Yeah, agreed. And when that's the longer term projection too of everything that's going on now, right? And so we'll continue to just pay attention to what's happening around the world with those, if there are manufacturing plants that are coming back in any way, shape, or form, right? We're still working on the semiconductors. I think those, IBM, Intel, um, was working on some gigantic plants in the Phoenix area and the Columbus, Ohio area, um, over the last few years. So like things like that are in the works, are happening, but they take time, and I think that's a good example of that too. Is I was that in 2020, 2021, when those plants
Yeah.
were planned and started, and
1819, somewhere that right time frame. Yeah. Intel's not the only one. We have Taiwan Semiconductor, which put in a massive plant in the northwest of the Phoenix metro area. And that's a foundry. That's actually where they actually make the chips. And I believe Intel has a foundry in the Gilbert area or Chandler down in that area. Um, so yeah, we are onshoring a lot of manufacturing, so it's an interesting deal to see.
yeah. Again, which is great, which is cool. It's like these are all good things, but again, they take time. They take years, not months. So we'll just keep watching that. The other thing I wanted to check on in the last couple minutes here, what are we seeing with recession indicators? And, Jay Powell came out with a few comments this week. The market actually took it pretty favorably. He said we're pausing, we're not making any changes, we're not lowering interest rates right now, and the market was like it had a good day, after he spoke. I believe I'm not misinterpreting that, right?
Yeah, yeah, it did. No, it's pretty good. It depends on the indicator you look at. Okay. So some say two-thirds of probability by the end of 2026 that we're going to have a recession. Most likely very, very mild. Most likely, bounce along the little bit of a negative number, come back. Some are saying, 30 to 40%. It starts sometime in the back half of 2025 into the first half of 2026. So it depends on the indicator. And I would expect the wide variation between the recession probability indexes because this is an event-driven issue, right? We had a pretty decent economy. It was slowing, but it wasn't slowing nearly as dramatically as it is today because of the trade talks, because of the tariffs that were applied. So, the longer it goes on, the more uncertain, the more uncertainty continues. People start to cancel their purchasing plans, whether they're a household or whether they're a business, and that does slow the economy. So, you know, at this point, I don't think we're gonna. At this point, I think if we hit a recession, it'll be fairly mild. But my guess is we're going to be slightly negative on GDP or around the zero, just somewhere around the zero. We're going to bounce along that, which we saw in the first quarter, right? We saw a negative 0.3%. To me, that's not a substantial negative number. When people talk about, oh, it's negative for 2 quarters in a row. Yeah, but it's got to be a little bit more. It's got to impact consumer incomes, consumer spending, household or corporate earnings more than it has, at least at this point. Now, that may be April and may bear that out to be totally different, and we might see that, and that's why we're waiting for some of the data, which Jerome Powell said we're waiting for some of the data to come through. The sentiment data or the soft economic data, surveys based on people's expectations are not great. In fact, they're terrible. Whereas their current situation index, for these surveys and the hard data are showing a much, much better situation. So if you follow that through, it means over the next 6 months, we're going to go from a pretty decent position in the consumer spending and income categories to a pretty negative one. Now, bear in mind that has all been priced into the markets at this point.
Mm-hmm. We would call that public information.
Yes, it's public information. It's nothing new. This has been this way for the past couple of months, this big divergence. So it's already, people are aware of it. People know about it. Investors have priced it into the markets, which is why you're still off 8% from the high. So do I think we're going to be a big negative? We might retest the lows of the stock market, but we may not as well. I think it's a very interesting, again, it's event driven. So if the market determines that President Trump's tariffs are going to be a non-event for equities and stock prices and their earnings, then it's going to be a non-event.
Well, as always, we will pay attention and we'll talk about it again next week and see where we're at. So thank you, Brad, as always, for being here with me. And for anyone who has questions, who would like to, see something in the news and they want to hear about it, you can literally send me any question anytime. And we will either hit it the next week or the week after, so we love answering your questions. You can get all of our information in the show notes and we'll talk to you soon. Thanks, Brad.
Thanks.
That's it for this episode. Thanks for listening and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.